Welcome students to the series of lecture on fixed income, and specifically the series of lecture is not only fixed income but also derivative products, and we are trying to cover fixed income plus derivative product in the series of lectures for CF and FRM. And today we are going to discuss a really complex topic. So if you're not pretty good with the concept of duration, if you're not pretty good with the concept of cheapest to deliver bond, which we have discussed in the series of lecture, then this is not the video for you. First of all, you should be good at these topics. First, duration, sensitivity, how duration is risk, and you should have a good understanding of the future contracts. You should have a very good understanding of cheapest to deliver bonds and the future contract in the Treasury bond future. With that, let's move forward. The discussion is how you can hedge the risk of a bond with the help of future contract. And I have written explicitly that bond duration is risk. Bond duration is risk because it's highlight the sensitivity between the interest rate and the bond prices, and you have to hedge the risk. So if a bond has a duration of 5, if a bond has a duration of 10, and a bond has a duration of 15, which one has the highest risk? The bond with the duration of 15, which has the highest duration, because duration highlights the sensitivity, highlights the uncertainty, and that's why duration highlights or explains the risk in a investment or a financial instrument or a bond. Now the question is how we can reduce the duration of a portfolio or a bond without buying and selling the bond, because if you buy and sell the bond, it incur a lot of cost, right? And you don't want to liquidate your portfolio just because the interest rate is falling or increasing. You want to hedge the risk with some financial instrument which has a very low cost to bear, and that's why we'll enter into a derivative market. And with the help of that derivative financial instrument, we'll hedge the risk. And the contract that we are entering into is a future contract. Okay, so let's start our unitary method to understand hedging a duration risk in a bond. So a bond has a duration of 10 and a future contract has a duration of 2. That's it. So if you buy more future contract, then what will happen to the duration of the portfolio? It will increase because you are saying bond duration is 10. It's positive. This is also positive. So if you buy more future contract, the duration will increase for the portfolio, right? If you sell the future contract, then the duration will fall. So if you buy one bond and buy one future contract, the net duration would be 12. If you buy one bond and sell one future contract, the net duration is going to be 8. But how many future contract I need to sell to make the duration of the portfolio equal to 0? So unitary method will say that, okay, the duration is 10 for bond and for future it is 2. So in a very simple term, what I need to do, I need to sell 5 future contract, and that will reduce my duration to 0. Okay, but there is a problem. The problem is the duration is related to or connected to the bond price. Because what is the definition of duration? The duration is the percentage change in the bond price. In this unitary method, you're losing the bond price due to 1% change in interest rate. So this simple unitary method will not work because you haven't talked about what is the bond price, what is the future contract price, because duration tells the sensitivity of the bond price. And where was the bond price? Where was the future price? If I say future duration is 2, I'm talking about if there is 1% change in interest rate, the future price will change by 2% in the opposite direction. So we have to incorporate price. So now bond duration is 10 and bond price is 1000. Future contract duration is 2. Future contract price is 100. Then, first of all, let's understand what it means, what duration means. If interest rate changes by 1%, then the bond price will change by what? 10%. So 10 upon 100 into the bond price, that is the dollar value change. So the dollar value change is of $100. And in the case of future contract, the duration is 2. It means if interest rate changes by 1%, the future contract price will change by 2%, and the future contract price is given as $100. So it is 2% of 100, that is $2. So if interest rate changes by 1%, the bond price is changing by $100. The future contract is changes by $2. Now, if I ask the question that how many future contract you have to sell, the answer is not 5, the answer is 50. Unitary method. right? If I need to compensate the change of $100, then how many future contract I need? The answer is what? 100 upon 2, that is $50. So it is unitary method, unitary method. So the answer is 50, not $50, 50 future contract you need to sell. Now, if you think very properly, this unitary method, then what you're writing value of portfolio or bond into duration of bond is equal to negative, because you're talking about selling the future contract. So value of the future contract into the duration of the future contract. So you're simply saying value of the bond into duration of the bond plus value of the future contract or price of the future contract into duration of the future contract equal to zero. This is your formula. And this is a universal formula. The problem in the FRM CFA curriculum that they don't talk about this simple formula, they will call it as DV01 or they will call it as BV01, whatever they call it as. They're simply saying that if you're trying to hedge, then you have to apply this formula, the value of the bond into duration of the bond plus the value of the future contract into duration of the future contract into X equal to zero. And you're trying to find that X, right? You're trying to find that X. So the X is the number of future contract you need, which will be value of the bond or value of the portfolio, duration of the bond or duration of the portfolio, divided by value of the future contract or the price of the future contract, divided by the duration of the future contract. Okay. Now, sometime they will call it as DV01 for the bond and DV01 for the future contract, or BV01 for the bond, or BV01 for the future contract, whatever they call it. This is a simple unitary method, and you need to remember this formula. Now, if I expand this formula with the same unitary method, if I expand the formula, then understand I'm saying value of the bond into duration of the bond or the portfolio, portfolio or bond. You can write bond, you can write portfolio. Plus value of the future contract into duration of the future contract into X is equal to value of the portfolio into duration that you're targeting. Now, if you're targeting a duration of zero, this complete section will become zero, which we discussed right now. Now, if the duration changes to one, this formula will become value of portfolio into duration of one. If the target duration, you don't want the duration to reduce to zero, you want the duration to reduce to two only, then it will change to two. This is simple unitary method. If you think properly, this is unitary method, nothing else. So we'll use this formula. Now, going forward for any calculation, if you're trying to hedge any bond portfolio with the help of any future contract, whatever written in the book, doesn't matter because this formula is a universal formula. Okay, now let's see the example. Now, the example that is given is the bond has a duration of 10.5. So, bond has a duration of 10.5. The bond value is $60 million. $60 million, that is the price of the bond. The future contract is, as in the duration of the future contract is 9.5, and the future price which is written here is $130.5. Now the quotation of the future contract is always given with the future contract size, and they might write it like 100,000 or $100,000. What do you have to do? This is a quotation. You can't do anything about it. So there is a quotation. So what you have to do every time, if the future price is given, future price is given, what you have to understand, this quotation is in the percentage of the contract size. That's it. So the final future price is what? The future price given in the percentage into 100,000. That's it. So this is a quotation. You can't do anything about it. This is a way certain market, certain instrument quote their prices. So it is saying 130.5 percentage of $100,000. So it is the final price is 130,500. That is the final future price. Now the question is, if the duration I want as the target duration to be zero, then what is the number of future contract I will sell? And if I want the duration to reduce only by one unit, as in from 9.5 to 8.5, then what is the number of future contract I need to sell. So you'll apply the same formula, the value of the bond into duration of the bond, the value of the future contract into the duration of the future contract into number of future contract is equal to value of the bond, which is the final portfolio, because at the end, the value of the portfolio is always equal to value of the bond because there is no value of the future contract in the terms of dollars. So therefore, value of the bond or value of the portfolio into the final duration that you are interested in. Here I'm interested in the first question. I'm interested in the duration equal to zero. That's it. So I put duration equal to zero. My right hand side becomes zero. Now, if I solve it, then it is value of bond into duration of bond is equal to value of the future contract into duration of the future contract into X. I have to solve for X and I'll get the value. That's it. Now, what about this scenario? In this scenario, I have to do nothing as in fancy. The only thing I will change that the target duration I will replace with 8.5. Now, what will happen? So value of bond into duration of bond plus value of future contract into duration of future contract into X is equal to value of bond into 8.5. Now, value of bond, the duration of bond. If I move it to the hand side, then this will get cancelled. And I have value of bond into the duration of bond or the target duration of the portfolio, because this is the target duration of the portfolio minus value of the bond into the duration of the bond. And the duration of the bond is given as the duration of bond is given as 10.5. So I'll write 10.5, not 9.5. That is the duration of the future contract. So the final formula will become as the value of the bond into the duration initial minus value of the bond into duration target upon a value of the future contract into duration of the future contract. That's it. You only have to remember this formula or this formula. That's it. And it will work. But there is a complexity. The complexity arises because of the cheapest to deliver bond in a treasury bond future contract. Everything is identical, but this conversion factor in the cheapest to deliver bond adds the complexity, and we have to understand that complexity. So, what will happen in any general question of a treasury bond future contract? They will talk about the duration of cheapest to deliver bond. And that's why I was saying that it is necessary that you understand cheapest to deliver bond in the treasury bond future contract, which is the previous video in the series of lecture. They won't give you the duration of the future contract because in the treasury bond future or any future contract, the duration is because of the underlying asset. And what is the underlying asset in a treasury bond future? The cheapest to deliver bond, right? So they will talk about the duration of cheapest to deliver bond, not duration of the future contract. They will talk about the CTD price that is given. And again, it is in the percentage term. So 120% of the future contract price. And they will give you the conversion factor. Okay. And they will ask you to solve the question and find the number of future contract. They're giving you the information about cheapest to deliver bond. They're saying, hey, take the duration of cheapest to deliver bond. Hey, take the conversion factor of cheapest to deliver bond. Hey, take the price of cheapest to deliver bond. And you have to find the number of future contract. So what we need to understand and what we should be very cautious of. So first of all, I mentioned that the duration of the future contract is because of the CTD bond, the underlying asset. That is perfect. Nobody can deny that. But do you remember we said that the the final settlement price is equal to future price into conversion factor? The final settlement price is equal to future price into conversion factor. And for the time being, just assume that there is no possibility of making any profit in the treasury bond future contract, then the final settlement price should be equal to cheapest to deliver bond price, right? So basically, I'm saying that cheapest to deliver bond price is equal to future contract price or future price into conversion factor. Let it sink and think about it. Cheapest to deliver bond price is equal to future price into conversion factor, right? So if I ask you if the cheapest to deliver bond, if cheapest to deliver bond changes by 1 unit, the future price will change by how many unit? You will say it will change slower. How much slower? It will change by 1 upon CF. Use the unitary method. So if cheapest to deliver bond changes by 1 unit, then the future price will change by 1 upon CF. So I can say the future contract moves 1 upon conversion factor times, 1 upon conversion factor times slower than cheapest to deliver bond. And this is a very important information. And we will use this information in calculating the right future contract. The problem is, the problem is you are given the duration of cheapest to deliver bond. You are given the cheapest to deliver bond price. And you're calculating the hedging with the help of cheapest to deliver bond, not the future contract, right? So the number of contract that you will get by using this specific unitary method formula will give you the answer that if you would have used cheapest to deliver bond, then these are the number of contract that you have to buy and sell. So if I say the value of the bond into duration of the bond plus value of the cheapest to deliver bond into duration of the cheapest to deliver bond into number of cheapest to deliver bond is equal to value of bond into the target duration. And if the target duration is 0, then I'll say the value of the bond into duration of the bond divided by value of the cheapest to deliver bond into the duration of cheapest to deliver bond. And this will give you the number of contract of what? Of cheapest to deliver bond, not the future contract. So now you have to apply this logic. If to hedge, if to hedge, you need 100 cheapest to deliver bond. And we need to answer in terms of future contract. And we know that the future contract will always move slower. The future contract will always move slower compared to cheapest to deliver bond. Then the question is, will you buy or sell more future contract or less future contract? Because the future contract moves slower than the cheapest to deliver bond. So you have to always buy more future contract. So in the formula at the end, you will always see that they multiply with the conversion factor. Why they are multiplying with the conversion factor? They are multiplying with the conversion factor because you're calculating the number of contract if it would have been the cheapest to deliver bond, but it is not cheapest to deliver bond. And that's why you have to multiply with the conversion factor to find out the future contract because you can only buy and sell future contract, not the cheapest to deliver bond. Cheapest to deliver bond is the underlying asset. Okay, so if in this question you get, say, the same bond, which has the duration of 10.5, a duration of 10.5, and the value of the bond is 60 million, what you will do? You will say the value of the bond is 60 million. The duration of the bond is 10.5, is 10.5 plus the value of the cheapest to deliver bond, that is 120% of 100,000, because this is the quotation we discussed about it. So it would be 120,000 into the duration of cheapest to deliver bond into X equal to 0. If you were trying to reduce the duration equal to 0, then you will find X, which would be 60 million into 10.5 divided by $120,000 into 9. But after that, you have to multiply with the conversion factor, that is 1.5. Always 1.5. If the target duration is not 0, if the target duration is not 0, if the target duration is, say, 8.5, so you'll simply add 60 million, which is the value of the bond or portfolio, into the target duration, that is 8.5. And then you will solve for X, right? You'll solve for X. So X is equal to 60 million, 8.5 minus 10.5 upon 120,000 into 9. Then you multiply with the conversion factor of 1.5, because this is always going to give you the answer of what? The number of contract if it would have been cheapest to deliver bond. but nobody can buy or sell cheapest to deliver bond in a future contract. You buy and sell the future contract itself. So the answer has to be in future contract. Okay. So this is how you hedge specifically in a treasury bond future contract where you have the concept of cheapest to deliver and conversion factor. With that, I'll pause. Thank you. Have a nice day.